The house may be paid off. The kids may already be grown. The realtor may have a buyer. And after decades of mowing the lawn, climbing the stairs, fixing the roof, and paying property taxes, selling the home can feel like the cleanest decision you have made in years. But before you sign the final papers, there are 3 tax traps older homeowners need to check. Not because selling is wrong, not because every retiree will owe a huge tax bill, but because many people over 60 walk into a home sale thinking, the first $500,000 is tax-free, or this was my main home so I do not need to worry, or my spouse and I bought this place so long ago that the tax part should be simple, and then the surprise comes later. It may show up when the tax preparer asks for records you no longer have. It may show up when a surviving spouse learns the timing of the sale matters. It may show up when the sale of a home quietly pushes income high enough to affect other costs in retirement. The painful part is that these problems often start before the sale closes. Once the deed is transferred and the money is in the bank, you may have fewer options than you had 1 month earlier. So if you are over 60, if you are helping an aging parent sell a home, or if you are a widow or widower thinking about downsizing, do not panic. But do check these 3 traps before the sale, not after. Let's begin with a simple scene. Imagine a retired couple named Carol and Jim. They are both in their late 60s. They bought their home in the 1980s. Back then, the neighborhood was quiet, the house was affordable, and the mortgage felt huge. 40 years later, the mortgage is gone. The neighborhood has changed. Their property value has climbed more than they ever expected. Their daughter says, "You should sell while prices are still high." Their realtor says, "Homes in this area are moving fast." Their friends say, "Don't worry about taxes. Married couples can exclude $500,000. That statement may be partly true, but it is also where the first trap begins. The IRS says homeowners who sell a main home may qualify to exclude up to $250,000 of gain from income or up to $500,000 for married couples filing jointly. But the rules depend on ownership, use, timing, filing status, and whether the home is truly the main home. That word may matters because the exclusion is not the same as saying the entire sale price is tax-free. It is not even saying every homeowner automatically gets the full amount. It is saying that if you qualify, you may exclude a certain amount of gain, and gain is not the same thing as sale price. This is where retirees get confused. If you sell a home for $700,000, that does not mean you have a $700,000 taxable gain. Your gain is generally based on what you sold it for, minus your adjusted basis and selling costs. Your basis often starts with what you paid, but it can be adjusted by certain improvements, depreciation, and other factors. That sounds technical, but in plain English, it means this. The IRS is not only asking, what did you sell it for? It is also asking, what did you have invested in it, and what happened to the property over the years? And for many homeowners over 60, the answer is buried in old boxes, faded receipts, canceled checks, contractor invoices, and memories. That is why the biggest danger is not always the tax rule itself. Sometimes the danger is selling first and trying to reconstruct the facts later. Trap number 1 is believing the home sale exclusion covers more than it really does. This is the myth trap. Many retirees have heard the phrase $250,000 exclusion or $500,000 exclusion, but they may not know the conditions attached to it. In general, the IRS says you must meet the ownership test and the use test. That usually means you owned the home and lived in it as your main home for at least 2 years during the 5-year period ending on the date of sale. The 2 years do not always have to be continuous, but the details matter. Now think about how real retirement actually works. A couple may move to Florida for 2 years and keep the old house up north. A widow may move in with her daughter after a fall but delay selling the home. A veteran may spend long stretches away from the house. A retiree may turn the old home into a rental while deciding whether to sell. An adult child may assume the parent still qualifies because mom lived there forever. But the 5-year window may tell a more complicated story. That is why the first question is not, did you ever live there? The first question is, did you meet the use and ownership rules during the required time period before the sale? And for married couples, there is another layer. For the larger $500,000 exclusion, joint filers generally need to satisfy specific requirements. In many cases, either spouse may meet the ownership test, but both spouses must meet the use test. The details can matter if one spouse moved to assisted living, entered a nursing facility, lived with adult children, or spent extended time elsewhere. This is not meant to scare anyone. It is meant to stop a dangerous assumption. Because when people assume the exclusion is automatic, they may sell too quickly, report incorrectly, or fail to ask a tax professional the question that could have changed the timing. Now here is the part widows and widowers need to hear carefully. There can be special rules for a surviving spouse. IRS Publication 523 says a surviving spouse may be able to use the larger $500,000 exclusion if the home is sold within 2 years of the spouse's death and other conditions are met, including not remarrying before the sale. That 2-year window can be important. Imagine a widow named Denise. Her husband dies in March. Everyone tells her not to make big decisions during the first year, and emotionally, that advice may be wise. But financially, Denise also needs information. If she waits too long to sell, she may lose a tax treatment that could have helped her, depending on her situation. That does not mean every widow should rush to sell. Absolutely not. It means the surviving spouse should ask before the 2-year mark passes. The question is simple. If I sell now versus later, how does that affect my home sale exclusion and my tax basis? That one question can be worth thousands of dollars. And the same is true for divorced homeowners. If a home was transferred in divorce, if one spouse stayed in the home, or if the property title changed, the tax result may not match what the family assumes. The home may feel like a personal asset, but to the tax system, it is also a financial transaction with dates, ownership history, and records. The second part of trap number 1 is thinking every property gets the same exclusion. It does not. The IRS says taxpayers who own more than one home can exclude gain only on the sale of their main home. They must pay taxes on the gain from selling another home. So if you are selling a vacation cabin, a second home, land, a rental property, or a house you used to live in but no longer qualify as your main home, do not assume the same rule applies. This catches families who inherit property, move states, or keep an old home just in case. A retired couple may say, "That house was our home for 30 years, but the tax question may be, was it your main home during the required period before sale?" Those are not always the same thing. Now let's move to trap number 2. Trap number 2 is not knowing your real gain because your basis records are missing, incomplete, or wrong. This is the paperwork trap. The sale price gets all the attention because it is the big number. It is what the realtor puts in the listing. It is what the neighbor asks about. It is what the family celebrates. But the tax calculation depends heavily on your gain, and your gain depends heavily on basis. For older homeowners, basis can be a mess. Maybe you bought the home for $92,000 in 1984. Maybe you added a bedroom in 1996. Maybe you replaced the roof in 2004. Maybe you remodeled the kitchen in 2015. Maybe you added a wheelchair ramp, upgraded the electrical system, replaced windows, or built a garage. Some improvements may increase basis. Repairs generally do not work the same way, and the difference between an improvement and a repair may not be obvious to a homeowner trying to remember what happened 20 years ago. That is why a shoebox of old receipts can suddenly become powerful. A $30,000 improvement that properly increases basis could reduce taxable gain, but if you cannot document it, your tax preparer may be limited in what they can safely use. This is where families often learn the lesson too late. An adult son says, "Dad put a lot of money into this place." The tax preparer asks, "Do you have records?" The son says, "No, but everybody knows he did." The tax preparer cannot file a return based on family memory alone. The IRS says, Publication 523 includes worksheets for determining gain or loss, how much gain may be taxable, and reporting the transaction correctly. It also says homeowners should keep records to document adjusted basis, generally until 3 years after the due date for the return for the year the home was sold. For seniors, that means one of the best things to do before listing the house is not cleaning the garage. It is cleaning up the paper trail. Find the original purchase documents if you can. Find settlement statements. Find invoices for major improvements. Find permits if they exist. Find records of additions, remodels, roofing, heating systems, plumbing, electrical work, and major accessibility modifications. And do this before the sale, while you still have time. The next basis issue is especially important for widows, widowers, and adult children. When a spouse dies, the basis rules may change. In many cases, part or all of the home's basis may be adjusted to fair market value at death, depending on ownership, state law, and whether the property was jointly owned or community property. This can reduce taxable gain, but the calculation is personal and should be reviewed with a qualified professional. This is one reason a surviving spouse should not guess. If Denise and her husband bought their home for $80,000 and it is now worth $600,000, she may assume the gain is enormous. But after her spouse's death, basis may not be as simple as the original purchase price. In some states and ownership situations, the step-up may apply to only the deceased spouse's share. In community property states, the result may be different. The details can affect whether the sale creates tax, how much tax, and whether the exclusion is even needed. This is also why adult children should be careful before telling a parent, "Just sell it." The tax result for a married couple can be different from the tax result for a widow. The tax result before a spouse's death can be different from the tax result after a spouse's death. The tax result in one state can be different from another state, and the tax result can change depending on timing. Now here is another part of the paperwork trap. Form 1099-S. Many homeowners think, if my gain is excluded, I do not have to report anything. Sometimes that may be true, but if you receive a Form 1099-S for the home sale, the IRS says you must report the sale even if the gain is excludable. IRS guidance also says you must report the sale if you cannot exclude all of the capital gain. This is a quiet trap because the homeowner may not understand what the form means. They may see messy paperwork after closing and toss it into a folder. Then, tax season comes, and the IRS has a copy of an information document showing proceeds from the sale. If the taxpayer ignores it, the IRS may not automatically know that the gain was excluded or that the basis reduces the taxable amount. The tax return needs to tell the story correctly. This does not mean every 1099-S creates tax. It means the form should not be ignored. The third part of trap number 2 is depreciation. This one catches retirees who rented out part or all of the home, used part of the home for business, or claimed home office deductions in the past. The IRS says if you were entitled to take depreciation deductions because you used your home for business or rental purposes, you cannot exclude the part of gain equal to depreciation allowed or allowable after May 6, 1997. IRS guidance also says if depreciation deductions were allowable but not claimed, basis may still have to be reduced by the amount allowable. That sentence can feel unfair. A retiree may say, "But I did not even take the depreciation." The tax rule may still treat it as allowable. That is why rental history matters. Maybe you rented the basement apartment. Maybe you rented the whole home for 3 years after moving to a condo. Maybe you used one room as a business office. Maybe you had short-term rental income during retirement. Any of those facts may affect the tax calculation. Again, this does not mean you did anything wrong. It means the sale needs to be handled carefully. Now let's move to trap number 3. Trap number 3 is forgetting that a home sale can affect more than the capital gains tax bill. This is the ripple trap. Many retirees focus on one question: will I owe capital gains tax? That is a good question, but it is not the only question. A home sale can create taxable income. That taxable income may affect estimated taxes, state taxes, Medicare premium calculations, taxation of Social Security benefits, and the net investment income tax for higher income taxpayers. Let's start with the net investment income tax. The IRS says individual taxpayers may be liable for a 3.8% net investment income tax on the lesser of net investment income or the amount by which modified adjusted gross income exceeds certain thresholds. The thresholds include $200,000 for single or head of household filers and $250,000 for married couples filing jointly. The IRS also says gain on the sale of a personal residence that is excluded from gross income is not subject to the net investment income tax, but gain that is not excluded may be part of the calculation. In plain English, if your home sale gain is fully excluded, that excluded gain generally is not hit by NIIT. But if part of the gain is taxable and your income is high enough, there may be another layer to review. This can surprise retirees in expensive housing markets. They may not feel wealthy. They may simply have bought a modest home decades ago in a city or suburb where values exploded. A retired nurse in California, a former postal worker in New Jersey, a widower near Boston, a couple outside Seattle, a longtime homeowner in Austin, Denver, Phoenix, or parts of Florida. They may sell because they need smaller, safer, easier housing, but the tax system sees a large gain. The next ripple is estimated taxes. When you sell a home with taxable gain, withholding may not automatically cover the tax. IRS Publication 523 notes that if you have taxable gain from the sale of your home, you may have to increase withholding or make estimated tax payments. This matters because retirees often do not have regular payroll withholding. They may receive Social Security, pensions, IRA withdrawals, or investment income. If a large home sale creates tax, they may need to plan how that tax is paid. Otherwise, the problem may not appear until filing season, and by then, the sale money may have already been used to buy another home, pay off debts, help children, move into a retirement community, or cover medical costs. The third ripple is state tax. Federal rules are only one layer. Some states have their own income tax rules, exclusions, withholding requirements, property tax issues, transfer taxes, or special treatment for certain sales. A retiree may move from one state to another and assume the federal answer is the whole answer. It may not be. If you sell in one state, move to another, and receive proceeds in the same year, you may need advice on residency, state filing obligations, and whether the state taxes the gain. This is especially important for snowbirds, widows moving closer to adult children, and retirees who sell in a high-tax state and relocate. The fourth ripple is Medicare. To be clear, Medicare premiums are not a home sale tax, but a taxable home sale can increase income on a tax return. And income from a prior tax year may affect Medicare income-related premium adjustments later, depending on the size of the gain and your overall income. So even if the home sale tax itself feels manageable, the income spike can have a second life effect. This is the part many retirees do not connect. They sell the home in one year, they file the tax return the next year, then a Medicare premium letter may arrive later. By then, the money may be gone or locked into a new house. That is why the question before selling should not be only, how much tax will I owe? The better question is, what else does this sale change in my retirement income picture? Now let's bring Carol and Jim back. Their house sells for a large amount. At first they celebrate. Then their tax preparer asks for records. They have the original purchase price, but they do not have receipts for the addition, the roof, or the major remodel. They also rented the home for 18 months while living near their son after Jim had surgery. They assumed the whole gain would be excluded. Now the tax preparer has to sort through ownership, use, basis, depreciation, selling costs, and reporting. Carol says, "Why didn't anyone tell us this before we listed?" That is the heart of the warning. The best time to ask these questions is before the listing agreement, before the offer, before the closing date, and before you promise children what you will do with the proceeds. Before you sell your home after 60, use this simple protection review. First, ask whether the home qualifies as your main home under the ownership and use rules. Do not rely on memory. Look at dates. When did you move out? When did your spouse move out? Did either of you live in assisted living, with family, in another state, or in a second property? Did you use the exclusion on another home in the last 2 years? Second, estimate the real gain. Write down the expected sale price. Subtract selling costs. Find your original purchase price. Add documented improvements that properly increase basis. Review whether there was any depreciation from rental or business use. If your spouse died, ask how the basis may have changed. Third, check the ripple effects. Ask whether any gain will be taxable. Ask whether you may need estimated tax payments. Ask whether state tax applies. Ask whether the taxable gain could affect Medicare premiums, Social Security taxation, or other income-based costs. Ask whether a 1099-S will be issued and how the sale should be reported. These questions are not meant to stop you from selling. They are meant to keep the sale from controlling you. Before you sell your home after 60, remember the 3 traps. Trap 1 is the myth trap, assuming the home sale exclusion is automatic, unlimited, or available for every property. Trap 2 is the paperwork trap, not knowing your true basis, losing improvement records, missing step-up issues after a spouse dies, ignoring Form 1099-S, or forgetting depreciation from rental or business use. Trap 3 is the ripple trap, focusing only on capital gains tax while missing estimated taxes, state taxes, NIIT, Medicare-related income effects, and other retirement consequences. The home may be personal, but the sale is financial. And after 60, a home sale is not just a real estate decision. It can be a retirement income decision, a tax decision, a widowhood planning decision, and a family protection decision. Before you list the house, sit down with your tax professional and ask one sentence. If I sell this home this year, what tax trap should I check before closing? Comment home if you want a simple checklist of documents to gather before selling a house in retirement. Share this with a spouse, widowed parent, or adult child who may be helping with a sale. And remember, the goal is not to fear the sale. The goal is to walk into closing knowing what the numbers really mean.